Hello, this is Giorgio Lucas. Welcome back to my YouTube channel. And today I want to talk about investment trusts and unit trusts and the differences between the two. First of all, let's just say that they are similar in one sense, is that you're not investing in one individual share. A fund manager here will invest across a number of different shares and potentially asset classes as well, like property, bonds, and both aim to diversify your portfolio. So what happens is that you're not at risk of one share doing badly and thereby your portfolio crashing. They're investing across a number of different shares, asset classes, bonds, and potentially in different regions as well, so that your portfolio can be diversified. That said, there are quite fundamental differences between the two. So let's first of all come to unit trusts. They're much easier to explain. So they're what we call open-ended. So what does that mean? That means they can accept almost limitless amounts of money going into the fund. They don't have a fixed number of units. So if many investors are pouring in to that unit trust, the fund manager will have to deal with a lot more clients, a lot more units, and the fund as well. Conversely, the number of people could be coming out of a fund as well. So there could be a lot of people leaving the fund and the number of units going down. It's not fixed. Also, the price of the fund always reflects the value of the holding. So if the value of the holding £1 million, that will be reflected in the price. Here you also with unit trust, you don't have live updates of pricing. They tend to be done on a daily basis. So during the day, you might not see the price of the fund updated. You might see it the day after. Investment trusts are very much a different animal, and they're often overlooked by investors. Up until a few years ago, they were almost unknown. And even to this day, 2020, not many people use investment trusts. So let's just go through what they are. They're basically companies that hold, as with unit trusts, what they do, they invest in other shares and asset classes as well. But the difference here is that they're listed on the stock exchange. So what does that mean? That means they're closed-end funds. They have a fixed number of shares. So unlike unit trusts, when somebody buys some shares, it will have meant somebody else would have sold those number of shares. And what you'll find, just like any other company quoted on the stock exchange, you get updated pricing. There's no waiting for the price like there is with unit trust. You get live pricing. Just think of the way I want to think you to think about investment trusts is that they're basically like, imagine, let's say, Coca-Cola. What is it trying to do to raise its share price to do well? It's trying to sell as many bottles or cans of Coke as possible and keep their costs down. And this is the same with an investment trust. It's just the same. It's a company, but what it does, it's a quoted company that's basically investing in other shares or asset classes. But let's just stick to shares for now. And that's all it is in that way. It's no different to even, let's say, British Telecom here in the UK. Their function is telecommunications. They're a quoted company, and you might get an investment trust. Let's say one which is known here, Scottish Mortgage. That is just a company that invests in other companies, hoping to beat the market, and it's quoted on the stock exchange. Now, what does this all mean? This all means that investment trusts, unlike unit trusts, are allowed to borrow. And if you're allowed to borrow in a rising market, that means many of the gains can be accentuated. Unit trusts cannot do that. Unit trusts cannot borrow. So in a rising market, investment trusts tend to do better because they can, like with any other company quoted on the stock exchange, they can gear up. So they can use equity plus debt to raise their share price. So any gains can be amplified. Conversely, though, a note of caution. In a market that's falling, investment trusts tend to fall further. Right. So with investment trusts, you're really looking at the longer term view. because investment trusts do not need to sell their assets even when investors sell their shares. Whereas with unit trusts, that's the case. Unit trust managers are forced to actually sell the assets they have, the shares they have, because they need to pay back their investors. And what we also find with investment trusts is they actually outperform unit trusts. They do a lot better in the longer term, even though in the short haul, they may be a little bit riskier. If you take a period of 5 to 10 years, investment trusts beat the market. Right. Also, another thing which is really, really important, as I was saying before, with a unit trust, the price always reflects the value of the holding. Now, with the investment trust, this is not the case. What you might find is that the price might not reflect the value of the holding. So when the price is greater than the value of the assets held in the company, this is known as a premium. And if the price is lower than the value of the assets held in the company, this is known as a discount. So in reality, what does that mean? That means, for example, that in certain investment trusts, people have a lot of confidence in the fund manager, so they're actually prepared to pay a premium to use that fund manager because they think they're going to beat the market. And conversely, if there's a heavy discount, investors tend to be not so sure about the fund manager in the company, and they're not prepared to pay good money for that fund manager. They think that value of the company should be lower because they're not good at investing in other shares. One thing you have to say as well, one good thing is that with an investment trust, unlike a unit trust, you also have an independent board. So it's there overlooking the performance of the investment manager, and it's easier for them to get rid of them and put somebody in because they have a vested interest for the company to do well. Now, I just want to take some examples here that for those of you based in the UK, there was an investment trust fund called Lindsell Train Investment, and they were trading at a massive premium, 75%. But had you invested that at that time, you would have made a huge loss because the investment premium has actually come down quite a bit, which does show that, as in any, share price can be overvalued because people potentially can have too much confidence in that share. Conversely, I don't know if you've been following the press in the last year or two and you've heard of Neil Woodford, and the disastrous performances he's had. And one of his investment trusts, Woodford Patient Capital Trust, did very, very badly. And the perception was, once his reputation was shot, there was a huge discount in that investment trust fund, and it was taken over by Schroder. Now, listen to this. Schroder took it over, and when I saw that, I actually put some money into that fund. And why did I do that? Because I actually thought that the discount was so heavy. I think at the time it was like 65-70%. It was absolutely huge. As we speak now, it's still well over 40%, but that discount has come down. And what does that mean? It means if the share price has gone up, and I've been able to make a bit of money. And this has happened during lockdown, COVID-19. I've actually managed to make some money here, and I'm quite proud of that. I'm very, very pleased I've been able to do that. It's actually called now Schroder Trust, Schroder UK Public Trust Company, and I've been able to make some money because the discount was almost too good to be true. And this happens with investment trusts. When discounts are they're too high, often investors will go in and are able to make some money out of it just by the discount narrowing. Conversely, when there's too much of a premium with an investment trust, the investor can lose money because perhaps there's just too much confidence, and the share price of this investment trust has gone so high that it really can only go one way. The premium is just too much. Another good thing about investment trusts is that they can hold back 15% of their income, whereas unit trusts have to keep paying out. Investment trusts can hold back 15%. each year. So what does that mean? That means they can pay this out in leaner years. So let's say when we had the financial crash slump in 08, 09, investment trusts were able to do this. So what does that all mean? Should you go for an investment trust or a unit trust? Well, I personally think investment trusts are a little bit riskier, but over a long term, they will do better. But as with, if you've seen the active versus passive investing, you've got to keep an eye out a little bit more on investment trusts and unit trusts, particularly because there's that added feature of whether there's a discount or a premium. So somebody like myself who's a very keen investor will look at investment trusts because they do outperform unit trusts. But I'm not condemning unit trusts. I've got some myself. So, and there are some amazing unit trusts out there to invest in. When I do another video, I will go through this, and I will go through as well what happened with Lindsay Train and Woodford in a little bit more detail. I just wanted to make this a little bit more generic today, just to give an idea of the differences between the two. I just want to go over one or two more little points. Investment trusts tend to be cheaper, so the costs are less. Mainly because there's been a lot less marketing done of investment trusts and unit trusts. You do see a lot of unit trusts advertised in the financial press. And with unit trusts, you often have to pay a platform fee as well. You pay a fee to the fund managers, sometimes half a percent, 1%, or whatever the fee is. The nice thing about investment trusts is that they're quoted on the stock market, so you can freely buy and trade. And with investment platforms such as Hargreaves Lansdown, you just pay £10, maximum 20 to buy and sell. So in that respect, it does make them a little bit cheaper. So my overall view is that investment trusts beat unit trusts, but again, you must never ignore a good unit trust. There's some very, very good ones out there. Being based in the UK here, I will discuss that in a later video. My recommendations for unit trusts, my recommendations for investment trusts. I hope this video has been of help. I know it can be a little bit confusing, but again, I just want to make that final point about what an investment trust is. No more than a company quoted on the stock exchange investing in other companies or other asset classes. That's all it is. Unit trusts don't do that. They're not quoted. They can get as much money in as possible. So you can have millions and millions of units. In fact, some unit trusts, disadvantage is that they become so big that they're difficult to manage, and this is with investment trusts, you don't get that. Anyway, okay, I will shut up now. I hope you've enjoyed this video. I hope it's been of use, and I'll see you very soon on the next one.